Let's bring on our next guest. He's John Kosar, Chief Investment Strategist at Asbury Research. John, are you with us?
I am. Good afternoon.
Good afternoon, John. Thank you so much for joining us today. Listen, I really want our listeners and viewers to hear about your long career as an analyst.
Sure.
Tell me a little bit about you.
It's almost 40 years long right now. I started in the early 1980s on the floor of the Chicago Mercantile Exchange. That's the futures exchange that trades the S&P 500, and back in the day they traded cattle and foreign currencies and just a number of different things. I started there as a kid in my 20s and kind of learned the business from the trading side. And I spent, I think, about 17 years there. And when I left the floor, I was an analyst for some of the larger firms on the floor, Shearson American Express and Deutsche Bank were a couple of those. And my job was basically to I would be given a very large order by an institution that I would have to fill, 400 to buy in a certain, say the S&P 500, over the course of many days. So my job was kind of finding value, finding low-risk areas to get involved in a certain market. I got off the floor in the late 90s because I wanted to expand my investment horizons to not just looking at the futures market or looking at a market in a 3 or 4 day kind of a range. And I worked for a few firms throughout that period, and then I actually launched Asbury in 2005. Asbury Research is in suburban Chicago, and we provide a number of different types of investors, from individual investors all the way up to multi-billion-dollar hedge funds with investment ideas, frankly.
We're going to drill down in just a little bit more about those things in just a few. But right now, we're going to take a short break. You've been listening to CEO Money. We'll be right back with more from John Kosar from Asbury Research. This segment was sponsored by Tycon Partners. All right, we're back with John Kosar from Asbury Research. John, you still with us?
I am.
Oh, good. So you gave us a rundown of your career, your long career as an analyst and being on the floor. And so that kind of leads me to my next question, because it's you've gained all of this knowledge and insight. So your forward-thinking insights as an analyst that has really separated you from the typical Wall Street approach. You want to just tell me a little bit about that and your difference?
Sure. I think it has to do with, all people who do what I do, whether they're an economist or whether they're a fundamental analyst or whether they're looking at quantitative things. We all have access to pretty much the same data, same reports, same information, same stuff out of the government. I think how we've differentiated ourselves, and what I've tried to do, is when you're on the trading floor, it's a little different than when you're investing in, buying Apple because you think it's a good company and you like their phone and you think that it's going to do well over the next 5 years. The trading floor, once you find a good company to buy, or once you find a stock or a commodity or whatever it might be that you think something is going from $5 to $7 a share, just say to pull some numbers out of the air. The thing that a lot of amateurs don't do is to look at it like an individual business. Like, I'm going to risk X on this stock so I can make Y. So in other words, I'm going to risk $1 on this stock to make $1. It's not a good trade, even if you feel really strong that Apple's going to go higher, whatever your stock may be. Whatever we do here, whatever we recommend, we have to have a strong feel on where the stock is going, or the ETF, And then we have to have a risk-reward ratio of 1 to 3, which means that I'm risking $1 to make 3, or I'm risking 3% on a stock to make 9, or even better. And we do that over and over and over again. And the S&P 500 is that's the universe. So rather than trying to pick out a mutual fund or an index, which is a conglomeration of many different stocks, many different assets, I can go through the entire S&P 500 and kind of siphon and cherry pick 5 or 6 that meet those stringent criteria that I need to find. And I think that's helped us to be successful over the years, is that, the risk portion, the risk part of this is more important than actually getting the direction right on a stock or ETF.
Interesting. Yeah, well, I've looked at it completely wrong. But some of the, what everybody is on the edge of their seat for, and we're all sitting here listening intently because let's talk about the near-term stock market future for the fall.
Sure.
What do you think?
I actually just wrote I wrote an article for Forbes. It's online. You can find it. I just yesterday, kind of about this perfect storm of all of these different things that are coming onto the financial markets here. All these different, impetus, things that can move markets over the next month or so. We had the earthquake in Mexico yesterday, 2 hurricanes, North Korea. You've got the Russian investigation by Mueller of the White House's involvement with Russia during the Trump campaign, and then there's this thing called seasonality. And what seasonality is certain financial assets have a statistical propensity to do certain things at certain times of the year. Seasonally, September is the weakest month of the year in the S&P 500 based on data from 1957. And if you look at it by the quarter, the last week of September is the weakest week of the entire third quarter. So we're coming into some seasonality that can potentially take us down for a month or so, very shortly here. So we've been telling our investors to be careful, to know what you own, to know where your pain threshold is. In other words, maybe when you may want to liquidate some stock or buy a put or do something to protect your portfolio.
Very, very interesting. I'm gonna stretch it out here just a little bit. Your favorite markets?
Define market.
Well, let me ask you. And tell me about your thoughts on some individual stocks.
I can tell you, I can give you a few individual stocks that we've been looking at. I actually have a.
Can we go there?
Yes, Asbury has a watch list here. A couple of stocks that have done pretty well for us, and I still think that there's a little bit of upside, is we actually made a recommendation to buy ABBV, which is AbbVie healthcare sector stock, back on August 7th at around $71.22 a share. And, this was one of those that just kind of fell in our lap. It skyrocketed. It's at $85.29 a share. I think we're up 18% on this particular one. I still think that it has another 8% to go until we hit a target of, what do I have here for a target? A target of $91 a share. We're trading 85. Another one we like is CarMax.
I'm sorry, John. I have to tell you, we've run out of time on this segment, but It's very interesting. And how can they reach you to get this information?
The best thing to do is to go to our website. It's asburyresearch.com, ASBURY research.com. There's a contact page there. You put your name and your email address there and mention the show, and we will send you some of our current reports free of charge.
Thank you so much, John, for being on the show and giving us that insightful information.
Thanks for having me. Have a great weekend.
Thank you.